Welcome to the Live Big podcast, where real estate expert Nick Paynes shows you that everyone can build wealth through real estate investing. Nick and his featured guests will give you the tools, resources, and expert information you need to leverage real estate into a wealth-building strategy, so you can stop worrying about your 9-to-5 and start to live big. Here's Nick with today's episode.
Welcome, everyone, back to the Live Big podcast. We are on episode number 12. Today, my guest is Aaron German. He's a loan officer for CMG Home Loans, soon to be HMA Home Mortgage Advisors, I believe, right?
Yep.
He's one of my premier lending partners in the real estate world. So Aaron and I have done, a lot of transactions together. So, anyway, thanks for being here.
Yeah. Thanks for having me. I'm a big fan of the show and honored to be here.
Awesome. Thanks. Well, one of the things that we're going to do today is we are going to talk about kind of a hot topic in today's market. I want to talk a little bit about how loans work kind of on a surface level, but I also want to talk about how rates are affecting purchasing power and just get into the numbers a little bit and figure out, so people have an understanding like what it really means when rates go up like 1%. So I want to talk about, again, how kind of these rate increases and decreases affect the average home buyer. And this can include somebody who's purchasing a second property or an investment property. It doesn't just necessarily have to be their primary residence. So we're constantly seeing in the news, we see stories about the increasing rates and how they're negatively affecting our real estate market. And what we see in the media, they're just using these kind of sky is falling terminology. And It's something that I think people, if they get a better understanding of where we're at, then people don't have to have this such a negative outlook on the housing market. So
sure.
So first, I want to talk a little bit about, just start with some facts. So where are we currently at in the market right now? Like what are interest rates looking like right now, and maybe give some understanding of how those rates are determined.
Yeah. So I mean, there's obviously some factors that go into the rate that the borrower would get. But the typical borrower today is seeing something in the high fives, maybe low sixes.
Okay.
Which is down quite a bit from where we were, 3-4 months ago. Right. So, certainly a good trajectory that we're kind of in the middle of here.
Okay. So. Yeah. So I know that, we hit as high as 7.5, almost even. And I think that was with even decent credit. Back in December at some point. Yeah. But one of the things to understand, again, people are looking at these numbers and they're, again, they're kind of acting like the sky is falling. But realistically, if we look historically at mortgage rates, okay, just a little statistic here for you, that back in 1971, we had a 3-decade period up until 2002 where rates never got below 6.25. So like Aaron said, rates are currently in the high fives, low sixes.
Right.
So we had a 30-year period there where rates never went below 6.25. And that would have been considered a base rate, or the best rate that anybody had seen during that time. Now, since 2002, rates have kind of dropped consistently to a low of around 2.75%. Okay. Mm-hmm. Which that was spurred by COVID, right? This was something to kind of help stimulate the economy.
Yep.
And, rates have since kind of gone up since that low, which was really Q1 of 2022. Mm-hmm. And now, like we said, we're seeing rates in the high fives and low sixes. And that's the highest that rates have been in over a decade, right? Because we've seen this decrease, and it's really been constant. It hasn't been there really hasn't even been a whole lot of volatility over that period of time. We saw a little bit of a volatility in the drop right during COVID, when we dropped down into the 2s, which were unheard of rates. Mm-hmm. And then obviously in the last year, we've seen some serious volatility going from 3 to 6 in a matter of what?
3-4 months.
Yeah. So anyway, again, if we look historically, it's the volatility that people are really nervous about, and what the media is using to kind of scare us into, look at how bad the rates are. It's that they're so volatile, right? It's not necessarily how bad the rate is. 6%, 5.75. Those, historically speaking, are really not bad rates.
Yeah, they're good rates.
So So I want to get into a couple of the key points of this episode. And the first one is really going to be, how do increases and decreases in the rates actually affect buying power?
Yeah.
So I know that you get to run numbers a lot. You get to see these things, as you're pre-approving people and going through your loans. Like, let's put it in terms of like cash, like what it's actually costing people when we see these types of rate increases. So can you maybe just walk us through an example of, what we might see on a typical loan?
Yeah. So the simplest way to really think about it is, what does it cost per thousand? Right?
Okay.
So when I'm talking to somebody, if they're like, well, how does it affect my payment if I put another 5, 10, 20,000 down?
Okay.
And generally speaking, the easiest way to conceptualize kind of payment versus rate is when you just identify a simple number. And so if you're borrowing an extra 1,000, putting another 1,000 down, and kind of how that rate can change, we're kind of in a neat spot now just because it's really easy. It's 6%. Not factoring in things like mortgage insurance and stuff like that, just the principal and interest, if that's what we're talking about. It's 6%, you pretty much have an equal payment per thousand. So 6% interest rate amortized over a 30-year loan is going to be about $6 a month per thousand.
Okay.
So as rates have kind of gone up, well, if it from 5 to 6%, it's an easier way to think about it when you think of the rate by 1,000 is kind of the same, I guess, byproduct of the payment. But from 5 to 6, let's say that your payment's just over $5 a month at 5%, and then it goes up to about $6 a month per thousand at 6%. So a difference of roughly $70 per month, or I'm sorry, 70 cents per month per thousand that you borrow based off the rate increase.
Okay.
So if you borrowed another 10,000, well, 70 cents, okay, your payment's going to go up $70.
Okay.
If you borrowed another 100,000, okay, that's where the big differences start to come in. So as you're looking at the cost of borrowing, if you can shake it down to a simple way of thinking about it, like what's the monthly payment per thousand? Well, at 250,000, let's just say, 200,000, right? If you're paying basically, we'll just say around $5 per thousand, okay, that would be roughly, $1,000 a month. Well, if you jack that up at 6%, now all of a sudden you're going to be paying a bit more.
Yeah.
So, I mean, so
like I think the good way to look at it is probably like if you use that 70 cent figure.
Sure.
So if you had a $400,000 loan, which is a fairly standard loan for maybe a first time home buyer here in Colorado, 400, 500,000, but at 400,000, if you go from 5 to 6%, you just take that. Yeah, exactly. You take that 400,000 and multiply it by 70, 70%. And you kind of have the idea. You got to move the decimal, but
right.
Essentially you have $280 a month or so. And that's plus or minus
increase in payment just between 5 and 6.
Exactly. Right. So now you have, and where people, again, where we ended up with people that got into qualifying problems was, they may have pre-qualified back, let's say March of last year and got pre-qualified at a 3.5% interest rate. Mm-hmm. And then when interest rates went to 6, the difference between 5 and 6, a couple $100 a month.
Sure.
The difference between 3 and 7,
pretty significant.
4 figures on a normal loan, right? So all of a sudden, people who were maybe qualified for a $2,100 a month mortgage payment are seeing their mortgage payments bump up over $3,000.
Right.
So we definitely understand the inaffordability that happens when we see these rate increases. But the problem is that the 2% and the 3% mortgage rates, those were an anomaly, and we're a product of COVID-19, right? And
sure.
And the need to kind of stimulate the economy. And so those rates, those 2 and 3% rates, really are kind of unrealistic rates anyway. So the people who were able to take advantage of them, purchase a house during that time, or even refinance during that time. My advice to you is like never get rid of that mortgage. Like hold that property forever, because the value of cheap debt the value of debt, especially the cheaper it is tremendous, right? To be able to have that. I mean, even if we look back into back when rates were, 18%, 16%, even 10, 12%, there was a point in time where it wasn't uncommon to see people doing seller financing, and for people to do what are called wraparound mortgages, right? Where they have the seller has the ability to sell the property, and then they can actually finance it and be the bank, and they can make somewhere between 8, 10, 12% on their money. Sure. And so if you're doing a wraparound mortgage where you have your current mortgage is 2.75% or 3%, and you can charge the person who's buying from you 9 or 10%, now you have a spread of a 6 or 7%. And so like there's some value in holding on to that debt. And sure. Anytime that inflation outpaces debt that you have in terms of interest, it's essentially free money.
Sure.
Right? Because the debt holder is actually losing money by holding that loan. Right. And so anyway, think about it that way. If you are one of those people with a low interest rate, really think about, and maybe because this is an investment podcast, right? Think about how you can set yourself up for maybe your next move. Start setting yourself up to be able to maybe keep that property that you're in with that 2 or 3% mortgage rate. Same thing. Even my strategy has changed a little bit. Properties that I had thought that I was going to sell, or properties that I thought that I was going to exchange out of into something new, it's kind of like, well, the debt is so cheap on those properties. Mm-hmm. I think I should probably keep them and find a way just to buy the next one without exchanging out.
Right.
And so your strategies start to change when you hold this really low interest debt. So that's one of the things that I think people need to think about. And again, from a qualification standpoint, I completely understand if you've lost your ability to qualify and when purchasing a house, that's one thing. The one thing I want to make sure that people don't do is that, and I think we've talked about this in one of our previous episodes, is that we're not stepping over dollars to pick up pennies. And that mentality is where we're not buying things because interest rates are 6%. And what happens is if we look at a 5% to a 6%, we already talked about it, and Aaron and I actually ran some numbers, but a $400,000 loan at 5% versus a $400 loan at 6%, the difference is about $250 per month. So we quoted $280, but it's about $250. So anyway, plus or minus a little bit. But the idea here is $250 a month is $3,000 per year.
Sure.
But that property of $450,000 or a $500,000 property, just in very basic appreciation alone, even if you just did inflationary appreciation at 2%, is going to increase in value for over $10,000 in the first year. And you're going to have somebody else paying your principal pay down. So why are we saying that we're not going to buy this appreciating asset that's going to bring us maybe $15,000 to $20,000 minimally in wealth, just because we don't want to pay the extra $3,000?
Yeah, I mean, that's kind of a big topic of conversation, and it kind of boils down to, as an investor looking at it, long term, interest rates are never permanent, right? You're not married into a 30-year mortgage just because you took one out. You can always refinance it. You can re-leverage. So though many people might just be on the sidelines kind of waiting for rates to come down, on the flip side, as soon as we have all this cooped up demand, right? I get if you're priced out of the market and you just can't buy, or what you could afford just doesn't match for your family. But from an investment standpoint, looking at it and saying, well, I'm going to wait to invest because interest rates are 6%.
Right.
And kind of like you always say, you don't wait to buy, you buy and wait.
Yep.
Well, the same kind of thing, the same kind of principle goes towards interest rates. You date the rate, you marry the home.
Absolutely.
So if you can get in even at 6% and negotiate some things, it starts to really improve the total ROI over the long term. If you're able to get either a cheaper purchase price, B, you get some of your closing costs covered, maybe even get your rate bought down a little bit. You just have a little bit more room to negotiate, where the increase in payment just becomes one of those very subtle things that as an investor you're looking at.
Right. And I think that's a great point, because like the other thing I want people to really think about here, and if you haven't done this, if you haven't gone through this practice, or you haven't tried this, go online and go find yourself a compound annual growth calculator. Compound annual growth calculator, CAGR is the acronym for it. But put in, as an investor, if you go and you buy a property and you have a 5% ROI is what you're kind of calculating. Okay, I'm going to get a 5% ROI. That'll be low, but we'll just use that number.
Sure, it's a baseline.
Yeah. So you have a 5% ROI, and then let's say you're working with somebody and we manipulate the loan a little bit. Maybe we get a little better purchase price. Maybe we get some concessions on the sale, and all of a sudden we're able to increase that ROI from 5% to 6%.
Sure.
The misconception a lot of times is, and it doesn't take a whole lot to do that, right? The misconception sometimes is people look at that and they go, oh, well, that's not a big difference, from 5% to 6%, that's 1% more,
right.
But it's not, it's 20% more, right? It's so the increase from 5 to 6, right? If you have 5 apples and go to 6 apples, that's a 20% increase in the amount of apples that you have, right? So people don't think about it that way. And so if you want to go through like the exercise of what the difference between 5% and 6% is, go find yourself a compound interest calculator or a compound annual growth calculator and put in, $100,000, which might be an investment on a property, for example, and run it for 30 years at 5% and then run it for 30 years at 6% and watch what the difference is.
Yeah.
It's massive.
Astronomical.
And so, it's so important to remember that if we can manipulate things and we can look at the market now and go, okay, there's some opportunities because of the increased rates. There's some opportunities to pick up properties that may have been sitting for a little bit. There's opportunities to get them at a lower price. There's opportunities to get a rate buy down, for example, which is going to improve our ROI. And then what's going to happen is you're going to be able to do that. Purchase a property right now in a down market. It's not a down market, but relatively speaking, kind of a down market, right? And then when rates get better, okay, which we're going to talk about in a little bit here as to why we believe rates are going to get better. But when rates get better, you have 2 things going for you. One, it's as simple as refining your property. And now you increase your ROI again because you increase your cash flow and you decrease your liability.
Correct.
And then you also increase, when you decrease your rate, your principal pay down goes up with each payment.
Sure.
Right? And so so the fact of the matter is when you're looking at this piece, you can kind of burn the candle from both ends and improve your ROI. And people aren't looking at it like that. And they're thinking, well, I'm going to wait till rates get better. Well, if you wait till rates get better, you're just going to end up in another buyer frenzy because all these other people are waiting for rates to get better too. And the inventory problem that we have, which we're going to talk about, that's what's causing the buyer frenzies and the seller's market that we've been in for 10 years is around rates. We've been in the seller's market for 10 years and rates were at 6-7% 10 years ago. So that's really the important piece for people to understand is let's look at your ROI and how we can get it from 5% to 6%, 6% to 7%. So
yeah. And, let's just kind of chit chat a little bit more on that. Let's say that you bought something and sure, you may be looking at, 6% or maybe investment properties are a little bit higher than that too. But let's just say somewhere between 6 and 7%. And you buy something now, okay, and you hold it for maybe a year or 2, and that's, what are we up, like 5-6% appreciation year over year, even through this?
Yeah, we're up a couple of percent. We're up 5% we're up 6% since the beginning of the year already. So in 4 months, we're up 6%.
Sure. So if you're looking at it in terms of even replacing your capital while increasing or decreasing your monthly payment and then increasing cash flow. I mean, when these properties go to work for you and when rates start to come down, the difference between just a regular rate term refinance and a cash out refinance really isn't that big in the grand scheme of things. I mean, it could be 1/4% or something like that, but you might even be able to re-leverage your equity to replace your investment completely.
That's right.
And which allow you to duplicate that and duplicate it and duplicate it to where your return on investment is already completed. You've already made your money back, and now it's just an earning asset for you in the long term. I mean, those are the benefits that we have here is you have in the current market with rates kind of where they are, demand isn't as high as it was, say, over the last 2-3 years, but there's still a lot of buyers out there. And appraisers, just like us, are human beings. And as they start to see, prices come down a little bit, they may adjust those prices.
Right.
But as things start to heat back up, I mean, we could be banked to see another banner year of appreciation as soon as these rates start to come down a little bit, and all this demand comes just flooding back into the market. It's not, in my opinion, it's not an ideal spot to be as an investor when there's saturated demand.
Agreed. Yeah, I mean, it's tough, and I tell people, and I have an upcoming episode on when to buy real estate, but it really comes pretty simple. It's like when you have the money to buy, that's the time to buy shit, because ultimately it's no different than buying stocks. It's, trying to time the market is a fool's game, right? And so the idea is like, if you can just use what we call cost basis averaging and just know that sometimes you're going to buy high and sometimes you're going to buy low, and the idea is to acquire property, right?
Sure.
If you sit around, if you have a bunch of money in a stock account and you sit around all year waiting for it to drop or waiting for it to get to a certain point, it's very likely that you're going to miss that mark.
Sure.
And then you're going to feel like and it may never happen. The stock could just keep going up. But sure. And finally you go, all right, I got to do something with this money. Right. And you end up buying the stock at its peak. Where if you would have just put a little bit of money every Tuesday into that stock, right, over 52 weeks, you would have had this cost basis average that still would have had you gaining.
Sure.
Right. And so that's one of the things we look at. And what's interesting is to look at just kind of the reaction that the market has had to the decreasing and increasing rates. Right. So again, the last time that we've seen kind of these higher rates, you have to go back to like 2007. Right. And so we've got a peaked rate of around 6.75 in January of 2007. And they really just declined ever since. So we've had like 13, 14 years of, more than that, 15 years of rates just continuing to decline. And again, very steadily, it wasn't volatile.
We've been spoiled.
We have been very spoiled. So 14 years of declining rates. Okay, up until 2000, really up until 2022, the beginning of 2022. And so it makes sense that we've also seen 12 years of increasing prices. Right?
Sure.
So we've seen this market appreciating, and this is one of the longest running kind of sellers markets that we've had with increasing prices. Now, we saw a slight pullback this last year, but that was more of a correction than it was a change in our market.
Right.
And the reason for that is that, because if we look at this, the kind of the piece of the puzzle that's really intriguing here is that with rising rates over the last year, okay, even though we saw this pullback, now that rates have they've kind of settled in that 6 range. Mm-hmm. And so they haven't been quite as volatile. They've maybe moved 1% here or there, but again, last year we saw 3% increase in a matter of 3 months. And so with those rising rates over the last year, we've still seen overall an increase in housing prices.
Sure.
Even though we saw that dip, even though we saw that pullback, like you said, year over year, which if we go back to literally 1 year ago, like today,
sure,
rates were tremendously good. They were very low 3s, right? And then we saw this huge pullback, but year over year, like we are still like doing pretty well. From January to January, it was something like we're right around even. And this is the Colorado market. I get that different markets reacted different ways, but we had one of the bigger pullbacks across the nation here in Colorado. We saw some properties lose as much as 15% of their value from the peak. But what they have to remember is that the value also went up 15% from January to March. We had a 3-month run up of a 16% in the beginning of 2022. And so we're still seeing, now that rates have settled in, like I said, this year, 2023, just the first 4 months, not even 3.5 months, we've seen appreciation of like 6 and 7% in some of our areas. And so in most of our areas and in our market wide kind of data. And so why is it that we're seeing this, like, even though the rate climate is still something where the media is out there telling us that we're, oh my gosh, the rates are going crazy and the sky is falling. Yeah, we're still seeing prices increase and we're still seeing multiple offers, and people are wondering, why is that? And it really just boils down to a very simple issue that we have. We don't have a rate problem. We've already established that these are not bad rates.
Right.
We have an inventory problem.
Yeah.
And so, and you see it, I think, even as a loan officer, right? You can see like how many deals that maybe you have the ability to do. There's not enough houses out there for people to buy.
Sure. Even through some of the toughest points of last year and even leading up to where we are today, we've had strong offers get outbid. And the real estate is not only a necessity, but when you're purchasing real estate, that's great. We can talk about, interest rates and stuff like that. But I mean, it's not like rent prices have just stayed even, right? So even rent prices are continuing to go up at or around, or even more in some cases, outpacing the hikes in rates.
Sure.
So when you're looking at it and you have high rates on one end, but high rent increases on the other, the better choice, in my opinion, is always going to be ownership.
Of course.
Because you can be creative with it down the road. And I think what's really coming to question is just how much education that, when rates are 2.5% or 2.75%, it's pretty easy, right? There's not a lot of education involved in it. Applications become a lot easier. But as rates start to go up, you as the loan officer need to put more work in and to educate these customers that, yes, I understand that rates have gone up and you may have been pre-approved last March at 3.25%. Here's how much you can qualify for. Maybe you were qualified for $400,000, but now you might be around the $350,000 range. But really the two properties might be exactly the same.
That's right.
Just because of where the market is.
That's right.
So are you really losing, or are you actually gaining opportunity? And I think that you would be gaining, because you ride the wave of appreciation as demand enters the market, and refinance and improve your cash flow and your monthly payments.
Exactly. And I know there's people from 2021, there's a ton of news articles about this as well. So 2021, 2022, out of all these, whatever consumer affair interviews or whatever they did with new home buyers, and they said something like home buyer remorse is at its highest level ever, right? Home buyer remorse is at its highest level ever. So people, are upset that they bought during this peak of the market. And I think you can look at this one of two ways, right? So you've got people that maybe bought in and paid $50,000, $100,000 over list price. And the reality is if you bought, let's say, a $500,000 home, and let's say you paid $575,000 for it, okay, but you got a 3% interest rate, and let's say a year later, okay, that property is now worth $500,000. It lost some of its value. Like we had that pullback. Now we're recovering, but let's say, for example, you bought it in February and then you decided to sell it in October for whatever reason. You would have seen a nice 12%, 15% loss, haircut on what you purchased the property.
Yeah.
But the problem that people don't understand is like you can't, it's sometimes it's very difficult to have your cake and eat it too, right? Like you're not going to be in a 2.75% market. That's a buyer's market. It's just not going to happen, because there's too many educated people out there that understand the importance of low cost debt and low cost leverage. So people that don't even want the properties, okay, or don't even need to live in them, are going to be buying them up as investment properties because they should understand the power of leverage and low cost debt, right? So the people that are upset about maybe buying in maybe April of 2022 because they paid $100,000 more, they paid $50,000 more, the same property selling for $75,000 less, say 8 months, 9 months later in October, would have still been more expensive on a monthly basis because of the increase in interest rates, right? So a $500,000 property in October at 6.5% would be more expensive on a monthly basis than a $575,000 property in March at 3% or 3.5%.
Sure.
Right. And so people so you could be upset and you could say, oh, I bought at the wrong time. Or we can look at this as like, not really, because ultimately what you're paying out of your pocket on a monthly basis, which is what we all budget upon, right? When we talk to people, and this is a great look at like an LO's world, right? People don't look at a big purchase price of a home and say, can I afford that? They don't go, can I afford $500,000? they call Aaron and they go, what would my monthly payment be on 500,000? Because I need to know if I can afford that.
Sure.
Right. Just innately as human beings, we have a hard time really grasping large numbers. And so again, even if we were to, even on a lower scale, like a 1/10 scale of that, buying a car for $40,000, right? People don't look at, can I afford $40,000?
Right.
They look at, what's the car payment?
Sure.
Okay. What is the payment going to cost me? Because we budget on a monthly basis. We don't budget on a yearly basis. We don't budget on a lifetime basis. We don't budget on a 30-year basis. We budget on a monthly basis. So we just innately, we have this understanding of numbers, but it has to be put into something that we can comprehend. And those numbers we can comprehend when they look like, they fall into the same category as what are groceries costing us and what are phones costing us, that type of stuff. That's why it's very difficult for us to understand how much money like $1 billion is, right? When we look at billionaires and people who have tons of money, it's hard for people to understand like how much money that really is. We're like, oh man, how are people buying this type of stuff? Because what they make in interest in one day is more than most people make in a lifetime. Right. So, and that's really powerful. Right. So I think that if people can understand that, I don't think, again, I'm all about cost basis averaging. So it's like, hey, whenever you buy, there's going to be a plus and a minus. You got a 3% mortgage rate, which is fantastic, but you got killed on the price of your house. Okay.
Right.
Or you bought 10 months later and you bought a property at a 15% discount of what the market called for 5 months ago, but you had a higher interest rate. Right. And so the only time this doesn't help you is if you're a cash buyer, in which case, yeah, if you're a cash buyer, I think you should wait for the pullbacks, right? And we know seasonally when those are going to happen. It's cyclical. It happens every year. So if you're a cash buyer, it says, when should I buy my property? I'm going to tell you, you should buy a property in August and September, or December, January.
Yeah.
And so, but ultimately what has happened is why, even though our rates have increased and decreased, like all the things that the rates have done over the past decade, and we still haven't really seen a reaction in our market from it, comes down to one thing, and it's inventory. We have an inventory problem, not just in Colorado, but in the United States. Mm-hmm. So a couple of statistics since 2012, okay, in the United States, so about 10 years, 15.6 million households were formed, okay? And a household formation is generally like when somebody moves out of their parents' house or they get married, they have kids, that kind of stuff, and they create a household out of it, okay?
Sure.
During that same time, we had 11.9 million housing units that were completed. Okay. So the problem is overall, we have almost a shortage of 4 million housing units in that time period. Okay. Now, 2.3 million of that housing shortage was single family. Okay. And 1.4 million of that was multifamily housing. Okay. So this housing shortage that we have, first of all, on a grand scale, again, hard to comprehend these large numbers, but 4 million houses short, okay, divided by 50 states, right? We've got a huge shortage in the United States everywhere. Colorado is somewhere in the neighborhood of 200 to 250,000 units that's short. And the problem in one of the big problems in Colorado is that we have new build permits that are issued every year. Okay. Now, the problem is the amount of new build permits that we issue is not enough to support the population increase in the household creation that we have coming into the state. And so we've seen population growth in Colorado somewhere between 70 and 80,000 people per year. Mm-hmm. And it just in general, about 30 to 40% of the population rents. The rest of them want to buy something.
Sure.
Right. So we're looking at needing somewhere between 50 to 55,000 units that people want to purchase and have a household. We just don't have that many new build permits.
Right.
So one of the arguments that we've had, that I've talked to people about is, so why don't they just issue new build permits? Well, it goes on a deeper level than that. It's all well and good to say, yeah, we can build some more stuff.
Sure.
But if we don't have the infrastructure to support it, that's where we run into problems, right? So in Colorado, if you've been here for any significant amount of time, you understand that we don't have the roads to support it.
Right.
We don't have the schooling system to support more homes, right? And we already have 32 kids in a class. We have a shortage of teachers. Half of our schools are dropping to 4-day school weeks because they don't have enough staff to cover it. We don't have the water supply. We don't have the sewer systems. In 2018, the city of Westminster had a 1-year new build moratorium, no new builds in the entire city of Westminster for a year because we had to dig up and replace a bunch of our sewer lines because it couldn't support what we already had, right? And so infrastructure change is not something that can change in a couple of years or overnight or whatever. Again, people that have been here for a long time, if you remember the T-Rex project, which was the change that we had in our highway system right north of downtown Denver, that was like a 10-year project.
Oh, yeah.
And the crazy piece about it was that the traffic right before we started the T-Rex project and the traffic after the T-Rex project was finished was about exactly the same. And so the point is did it fix the problem we had? Yes, it did.
Sure.
If we wouldn't have done it, it would have been unbearable. The traffic rate is unbearable. But now
some areas even where it's just the traffic is too much.
It's terrible. The traffic's terrible now. So we don't have the infrastructure to support the increase in inventory that they're calling for. And so it's not economically, it's not as easy as just saying like build more homes. It's interesting. Actually, just this morning, I got an email regarding some of the policies that are coming into that they're are at the House right now. Jared Polis and the government, they're trying to figure out how we can create more affordable housing for people. And one of the things that they're proposing is to change residential areas. So single family residential areas is to change the zoning and do what they call upzoning, right? To allow more than one housing unit to be put on a single family residence lot. And so
popular in California.
Right. So either to do that through an ADU or to just scrape it and put duplex, triplex. In fact, what they're trying to pass through is that on any single family unit or single family residence lot, as long as it fits within the parameters of the lot, you should be able to, you can put up to 6 housing units.
Wow.
And some of the really controversial pieces of this bill are that not only are they saying you can put up to 6, which we think is going to get scaled back because there's just no way.
Yeah.
There's just no way.
6 units on a 12,000 square foot.
It's crazy. So one of the controversial pieces of it is that they're going to try to put these things into place and eliminate the majority of red tape around it.
Sure.
Like they're going to try to eliminate the need for rezoning, permitting. Like they're going to make it easy to build. And they even went as far to say is if they pass these laws will actually supersede any like HOA restrictions. Now you can see how this could be potentially problematic, right? Like in a neighborhood where you have a bunch of single family homes and some investor wants to come in and go, you know what, I could scrape that house there. It's a big enough lot. We could put a 6-plex on that.
Right.
Would you like to be the neighbor of a 6-plex? Right? Probably not. And then all of a sudden, the HOAs can't do anything about it. So I'm sure this bill is going to get changed 100 times before it passes or it doesn't or whatever happens. But there's real talk about how we are going to fix it. And the only way to really fix it is to create more housing density. Because we in Denver, for example, there's no more areas to build in Denver. There's very few areas to build in Westminster, right? So it's how do we create more density in those areas? But again, the problem becomes, what do we do with our infrastructure?
Right.
And so when people look at these things and they're waiting and they're sitting back and they're going, I'm just going to wait for rates to get better. I'm going to wait for housing prices to come down. You are going to be waiting for a really long time.
Yeah. I mean, you can't outsave the market, and supply and demand is just going to run its natural course. There's a sweet spot, but like you said, it's incredibly hard to gauge. And kind of all this stuff that we've been talking about is part of the reason why I absolutely love older homes.
Yeah.
I love older homes just because the lot space.
Yep.
And I mean, as an investor, your property taxes are a lot lower.
Yep.
So when you're looking at infrastructure costs, it's incredible. And it's all passed down to property owners via property taxes.
Right.
And, even new build, the process, okay, well, if we have 50 to 80,000 people moving here every year, how long does it take to build a new home?
Right. And they've been, and we are at like an all-time high as far as how quickly builders are knocking out homes.
Yeah.
And so they just can't keep up with the problem is that we're already in such a big deficit, and we're adding to that deficit every year. So we have to increase our building just to offset what's being added to, let alone chip away at the
failing water.
Yeah.
We're so far behind that as an investor, it's a great spot to be, because you see a lot of safe harbor in real estate in Colorado specifically.
Right.
And it really helps that buyer remorse piece. So as we're talking about just kind of, the difference in rates and things like that, I mean, it's one of those, again, real subtle ingredients to the savvy investor, the savvy homeowner looking to build wealth over time.
Right.
And it's one of the things that I just love the most out of real estate.
Yeah. And I think as long as people can kind of, again, understand that, not, and when you're investing in real estate, I think when you're investing in anything, you're not always going to hit a home run. Like I got a couple of properties that I'm like, I wish I would have done something different. Right. But they're not bad properties, and the appreciation helps. But like after years of holding them, like cash flow should be better, and they're not. And so, it's frustrating from that standpoint. But overall, am I glad I bought the property? Yes.
Yeah.
Do I wish I would have bought something different at the same time? Yes.
Right.
Because what I'm glad I did was I bought something. I'm glad I bought something.
Sure.
And so that's the hard piece here, is like when you get to a point where you're ready to invest, when you get to the point where you have the money to make a purchase, and I don't get rid of the word invest. When you have the money to make a purchase, like you should own a home. That is the reason why that homeowners' net worth is 40 times that of a renter, and it doesn't have to do with the size of their 401k or their savings account. It has to do with the fact that they purchase an asset that appreciates $20,000, $30,000, $40,000 a year with minimal cash.
Right.
And so you don't even have to be an investor. If you're looking to buy a home, buy a home. Like don't wait, because things are going to get worse. And as Aaron said, you're not going to be able to outsave the market. And the reality is our cycle of real estate that we go through, the sellers markets, these kind of up markets, last way longer than the down markets. And so you get to a point where we go up, and then we drop a little bit. That time period to buy is really quick. Right. So if you're not ready to go, you might miss that market. And the reality is every time we go up, the dip that we see, the biggest dips we've ever seen is 20%. So we might go up 80, 90, 100% before we see a 20% dip.
Mm-hmm.
Right. And that 20% dip, again, that's happened like twice. That was in the housing crash and in the Great Depression. That was like about it. Every other housing dip that we've seen has been, 10%, something like that, 5%, and some of the smaller ones. The reality is you're going to wait around and lose 80% appreciation just so you can buy when it goes down 5%. Right. It just doesn't make any sense. And so, like, I think it's really important that we understand that you can't time the market, and you can't time the rates, and you don't know what the rates are going to do. That being said, I want to spend, we're almost done here, but I want to spend a couple of minutes. Aaron, what is your outlook for rates?
Yeah. So today, I honestly think that, and a lot of other economists and colleagues of mine think that sometime in the next, year or so, we could be back in the fours. And, to be honest, 2018, we were locking rates in the high fives. We've already recovered quite a bit. And if you look back at 2018, you don't see any, devastating economical events.
No, and people were loving 2018.
And it was just a great year. You could have people be able to get maybe some of their closing costs covered and stuff like that. But at the end of the day, you're still in the high fives. So that's where we're at today. But yet we still have inflation that in today and yesterday, the consumer price index and the producer price index came out and showed that inflation is in fact still starting to decrease year over year and month over month.
Sure.
And pretty much immediately shows a positive in the bond market, which is, really driven by investors. Sure, the Fed funds rate and the Fed's involvement has an indicator as rates move up and they move down, but pools of investors jumping in and out of bonds can move a rate sheet. So I think that, we were talking about this yesterday. I think that over the next 3-6 months, it wouldn't surprise me if rates were back into the high 4s, low 5s, maybe in the next year or so, could find a nice healthy medium in the low 5s to mid 4s. I don't think high 6s, 7%. I think what the Fed has done and, some of the outlook, which I don't know if we'll talk about, but some of the banking crises that have been going on, I think the Fed is starting to realize how hard, just continuing to increase rates has been on our economy.
Yeah.
And I do believe that's going to start to slow down.
Yeah. Yeah. There's some things, and I don't think we'll get into them today, but there are some things that, the recent bank closures that we've had and I think we can probably do another episode just on how the bond market works with rates and why we're seeing the bank closures and what that means and why it shows a lot of proof for or indication that rates will recover or rates will come back down. It's because they kind of have to. Otherwise, we end up in a different kind of crisis. Sure, we can end up in a banking crisis, and so we'll maybe get to that in a different episode. But I think that's it for today. Aaron, I really appreciate you taking your time to come on and chat with us about some of the rate stuff. Again, Aaron German with we're just going to say HMA because I think it's changing in a couple of weeks. So Home Mortgage Advisors. He's a fantastic resource. So if you've been thinking about even just, getting into investing in real estate or purchasing your first home, really your first step anyway, if you were to call a real estate agent, your first step is to get in touch with a lender and figure out what your qualifying power is. Right. And Aaron has a great grasp on that and helps people get through. And not only from what you can qualify for now, but how you can put yourself in a better qualifying position. Okay. Even if it's just a little bit of credit repair. He's not a credit repair specialist, but he's been through it so many times. Like he can give you some tips on repairing your credit, helping increase your credit a little bit, and just some different tools and tricks that you can use to get into your loan. A lot of people come in with misconceptions about, I need to have 20% down to buy a house. It's actually far from that. They have misconceptions that they should pay off all their credit card debt. Credit card debt's like the worst debt that you can have, but when it comes to buying a mortgage, it's one of the best debts you can have. Sure. Because they're only counting, the minimum
payments. Right.
So anyway, there are some things that they can guide you on. So before you make any big financial decisions about, I have to pay off my credit card debt first, or I have to pay off my car first, call and talk to a loan officer, specifically Aaron, because he's going to be able to walk you through that stuff. So anyway, check out his information. Will be in the write up for the podcast. You can catch him on social medias and his website and that kind of stuff.
On the book face.
Yep.
On the Twitter.
Yep. So
Instagram.
These on all of them. So we'll have all of his socials posted in the show notes, and go down, check out his reviews and give him a call if you have any questions. So anyway, that's it for today. Appreciate you tuning in, and hope you'll join us again next week for more awesome stuff. I don't know what next week's episode is going to be about yet, but I'm sure it's going to be fun. So anyway, thanks again. Drop a comment below if you have any questions, something that you want us to cover. We'd love to address it. So thanks for tuning in, and remember, go out, live big.
Thanks for joining us for this episode of the Live Big podcast. For even more real estate and investment resources, go to blackyetigroup.com/resources and download Nick's complete guide to running your own rental properties. Tune back in next week for another episode, and until then, live big.
Live Big does not provide investment, legal, or tax advice, and nothing herein should be construed as being financial, legal, tax, or other advice. Live Big does not represent that any securities or services discussed are suitable for any investor. No investment or other decision should be made solely based on the contents or information found on the website or podcast. When making a decision about your investments, you should seek the advice of a professional financial advisor or qualified expert.